dollar. Sometimes the dollar's the thing, and sometimes the curve's the thing. Sometimes sometimes it's the story. Sometimes you haven't got a clue what it is, and that's okay, because sometimes nobody knows what it is. It's just noise. The market's just moving because of noise. We've got to just be aware that some things are going to start changing the type of correlation that we have. This is one of the reasons why, when we talked about it this morning, I was talking about endogenous indicators of trading. And when we talk about endogenous indicators, these indicators are directly linked to the actual products. So the ability for them to vary significantly is very minimal. And that's important, because if you're looking at gold and bonds, there are certain scenarios where gold can go in the complete opposite direction to bonds. When we look at bonds and equities, there are certain scenarios where equities and bonds can go in completely opposite directions. When we look at bonds and the dollar, there are even scenarios with the bonds and the dollar that they can go in completely opposite directions. None of those markets are endogenous. They're all exogenous. They are all externally driven by their own individual drivers. If we want to try and find the very best of the very best, we need to look inside the market itself. When we look at the very best of the very best, we're looking, for example, in equities, we're looking at the PREM. We're looking at the price of volatility. We're looking at the highs, lows. We're looking at the advancers, decliners. We're looking at the gamma line. When we're looking at bonds, we're looking at the bond interest rate curve, the relationship of the 5s and the 10s and the 2s and the 30s. We're looking at endogenous markets that are linked to the product. When we're looking at oil, we're not looking at gas. We're looking at gasoline, and we're looking at heating oil. When we're looking at soybeans, we're looking at meal. We're looking at soybean oil. We're not necessarily looking at the dollar or corn or wheat. These are the endogenous products of these markets. And the closer you get to an endogenous product, the more value that line has for us. And when we look for endogenous, the problem we've got is, of course, that a lot of the times we don't see anything. And that's why for a lot of people, they don't use the endogenous lines, because they don't show an awful lot of opportunity. This is why when we were talking this morning, it was very clear that the big endogenous opportunities that we get comes back to a question and answer that we had with Mike many years ago when he was asking about the very best line opportunity. We'll certainly be touching on that again today, but I also want to touch and finish off our classroom on trading from the dark side using the market maker auction into this afternoon's session. We'll certainly be touching on that as well. We've also talked about the Fed dots plots today. We've had a class on that this morning in London. We've talked about the dots. We've talked about the macro picture. We'll certainly, on Friday macros, we'll certainly take a chance to look back all over the things that we've certainly covered in the London session, so that we don't leave anybody out. Anyway, it is Friday, and the markets are very quiet, as you would imagine, and a lot of people say, I don't get it. It's a big high volatility day, but obviously you've not read the news then, if that's the case, because we do have big news coming out this afternoon, and of course, it's not actually that far off, so we don't want to hold you back before we get started here. So, when we're looking at this, you might say, well, where the hell is all the news going? Well, they've got a problem with their economic calendar just now in this format, so there's not an awful lot we can show you in this. Look, it's just a big blank screen. So I know they've got a technical problem with their economic calendar, but that's okay. There's plenty of others, all free resources. There's a Forex Factory, of course, and there is Financial Juice, and they've got their calendars as per usual. So when we're looking at these numbers, you'll notice that as we come into Fridays, let's get through the numbers that we've seen. So average cash earnings in Japan looked pretty good at 4.1%. However, the household spending seems to have dropped. So the earnings have gone up, but they're not spending the money. Must be putting it in that very low interest rate deposit account. So moving past that, German factory orders, which is an oil-related trade, you see comes in at minus 2.9%. Really disappointing number for the Germans there. Offset somewhat by a buoyant UK retail sales number at 0.6% against a forecast of just 0.3%. So moving past all of those numbers, you can see that they all pale into complete insignificance when we move into the big one for the afternoon session. And of course, the big one for the afternoon session is going to be this little fella right here, the non-farm employment change. The Fed is very focused. They haven't mentioned inflation for a while, Jack. They've been kind of passing over that and really focusing on the tightness or otherwise of the jobs world. And I think this is probably the most important non-farm payroll that we've seen in a long, long time. Additional signs of weakness certainly gets that Fed moving, and any signs of good positive strength certainly could start putting a few holes in any top edge equities. And again, we have to remember that at some stage, bad employment numbers actually are going to start impacting on equities at higher prices as well. So, I mean, a really, really stinking number should be good for equities initially, but if it's a really bad number, we would probably imagine that some sellers are going to start looking at it saying that could be a big problem for us going forward into the future. So don't lose sight of the fact that there is a Goldilocks zone in most numbers. Too hot, like inflation, for example, whereas inflation that's not too hot, but still inflation can show the signs of growth, demand, and all those kind of things, which is generally good. Whereas a negative inflation when the market's been too hot can usually be very good for us, but negative inflation generally as a rule is not very good for us. So there always is a bit of a finesse to all of these types of numbers, isn't there? There's always that Goldilocks, and it all depends upon where we are in the economic cycle. So if we know where we are in the economic cycle, good news can be bad and bad news can be good, or exactly the opposite. Good news can be good and bad news can be bad. So it changes. And for people who think good news is always good or bad news is always bad, they simply haven't grasped the concept of what trading is all about. It's already priced in, it's already not priced in, it's already underpriced, overweight, underweight. There's a lot of nuance to everything we do with these. So anyway, the number's expected to come out at 75,000. Let's see if it does. If it is a little bit lower than that, then of course that's going to be a very strong case for the Fed dropping. The bond price has already rallied significantly. So unless it's a significant move below that number, I'm wondering if the bonds have a lot more to the upside to give us. A number that is above that, of course, suggests perhaps that everybody's baking in a little bit too much of a Fed move on this series of numbers. And therefore, perhaps it's maybe a chance to just unwind some of that trade itself. So we'll have to wait and see. We'll have to wait and find out, unless you're already positioned for something, which would be a bit dangerous, because this is a very, very important number this time round for the Fed. Also, don't lose sight of the average hourly earnings expected to come in line with prior of 0.3%. But certainly this 75,000, this is the one for this month. This is the biggest number we've had this month. And we do not want to lose sight of the possible drive-through impact that this could have. Unfortunately, as I said, we don't have that FinSource economic calendar. They have been having some technical problems, and for whatever reason, they failed to fix it. Anyway, I will leave you to look at your own numbers. I'm sure you've all got the ability to do that. So I'm going to grab some lunch and then we'll get started.